Hey everyone, welcome back to the Unlocking Doors podcast. My name is Cory Meals and I'm here with Michelle Castle. Today, we are going to be talking about some opportunities we've seen in the market for investors, and we're going to talk about some different loan strategies that they can use depending on what they want to do with the property when they buy it. So, Michelle, I have had several investors come to me lately that are seeing more inventory in the market. They're seeing those opportunities that we haven't seen in the past couple of years, and they're making offers. They're getting properties contracts accepted, and they're talking to you about their financing strategy. So let's break down the difference in what they're doing and then how you might guide them. So for somebody who's going to buy something, fix and flip,
okay,
what kind of options are you seeing them go with right now? What are you kind of telling those folks?
well, honestly, if that's going to be your strategy, my first conversation with an investor is, can we not just set up a line of credit,
Right.
so that you can quickly purchase a property, make a cash offer, and that line of credit is typically secured by some kind of cash held at the bank level. So you could do a line of credit against stocks and bonds. You could do a line of credit against a CD. You could do, so that's the easiest way to buy investment property. If that's not an option to you, you just need to be prepared to have 20 to 25% down payment on the purchase of a home. And there's some local banks that I like to work with on those types of transactions, because as a mortgage lender, I'm not going to do those short-term fix and flips. Right. But I certainly know how to do it. So I like to have that conversation. That excites me. I like seeing investors get into the market. So whenever that's the case, there's banks that will allow you to purchase the house and even borrow the money for the fix-ups as part of one loan, so you can get it ready to flip. In some scenarios, you're going to put maybe your down payment and then cash. You just bank it yourself, or you're just going to pay for the repairs out of pocket.
Right.
I know you've got some experience with those fix and flips too. How do you do that?
So I've done it a number of different ways. I've gone to the bank and said, I'm buying this property, and they'll say, we want you to put 20 to 25% down. We'll finance the purchase price and we'll finance the repairs. And so you're putting 20% down on the total cost, which is, if you think about it, it really helps you out from a cash flow perspective. You're not having to put 20 to 25% down on the purchase and then finance all of the repairs. The bank's going to front that money for you. I mean, you do have to put some money down on the repairs, but you're not putting the full amount down. And so that can really help with your cash flow situation. And, I think that's been a great option for me.
I do too.
The other one is, like you said, using a line of credit. I've done that on a couple transactions now with, basically a line of credit against some equity I've got in other property. And that's worked out really well, being able to make a cash offer.
It's a quick close.
And that's what I've seen entice sellers to take my offer.
Right.
Is I tell them, hey, I can close next week as long as the title company is ready.
And it's cash. So as long as of course, you're a licensed real estate agent, so you're comfortable with what you're paying for the home, but you don't have to have an appraisal in that scenario. I mean, there's a lot that you cut out going that route. If someone's, the downside to that, it works out great on a fix and flip because you're going to pay it off. You don't care if it's a balloon note. You're not worried about the long-term rate.
Right.
But if someone's going to hold their property.
Yeah, then because those lines of credit are interest-only payments. So, if you are doing, and that kind of brings us to the next point, if you're doing a buy and hold, or maybe it's like a buy, fix and hold.
Yeah.
Then that's definitely where, maybe you start with the line of credit for the repairs, but you definitely want to refinance into some long-term debt. And there's a couple different options there, whether you're going with the bank or going with maybe some of y'all's.
Yeah, we've got a couple of good options for that. If you're going to buy and hold, and renovate, we can do a renovation loan.
Right.
And then, it's 20 to 25%, just like at the bank, but it's a fixed mortgage instead of a bank balloon. And rates are typically better.
Those are 30-year notes too,
Those
right?
are 30-year notes.
Yeah.
So those are 30-year fixed rate notes. So it's a great option.
At the bank, you're typically getting an adjustable rate every 5 to 7 years, depending on what bank you're talking to, and it's
they're
it's
20
amortized
20-year.
over 20 years.
Yeah.
So it once again helps with cash flow, which a lot of those buy and hold investors are really looking at their cash flow on those properties. So
The down, sometimes now if someone's buying a house, the house is perfectly fine like it is, and we just do a regular mortgage, rate's going to be better. The process is the same. You can do it with as little as 10% down, but you're going to have mortgage insurance. It's a little bit harder loan to come up with. I think 15 is a little bit better, but rates significantly change at that 20 to 25% down payment mark. But sometimes the cash flow or qualifying is a problem, especially with a new investor.
right.
And that's where those DSCR loans come in.
And tell us a little, what does DSCR stand for the people out there that are
Debt
listening?
servicing
Coverage.
rate. Ratio. Good gosh. Why'd you ask me? You knew the answer.
I know. I just wanted you to tell everybody.
Debt servicing coverage ratio.
And explain what that means for, and is that a loan I know banks, like local banks and credit unions will offer those kind of products. Is that something y'all offer, or is that?
Yeah, we don't service those loans, but we can offer it as a broker product.
Okay.
So we will originate the loan, we'll process the loan, we'll close and fund the loan, and then it'll be serviced by somebody else.
Okay.
Those are fixed rate mortgages. You can do them, the down payment is the same as a regular loan, but the amount of the down payment is not going to be based on your debt to income or any of that. It's going to be based on just the recovery of the debt or the coverage of the debt. So basically we're taking, what's the rent income going to be on this house? What is the payment with taxes and insurance on the house? And are you cash flowing?
Right.
And if you're cash flowing, then we're going to base a loan just based on that cash flow.
Right. And that's basically the way I've heard it put is the DSCR loans qualify the property. I mean, obviously you still
you still have to credit qualify.
Yeah, you still have to credit qualify as the buyer, and you still have to qualify, I guess, but it's really qualifying the property. Does the property meet those loan terms?
Right.
During the COVID market, when we had rates in the low threes and people were getting these DSCR loans, they were, properties were cash flowing very nicely. And that drove values up. Now with rates, and rates are coming down a little bit, but rates are still a little bit higher than what they were during COVID times. And so that does affect what these properties will qualify for a DSCR loan. Lenders are looking at, okay, if you rent it out at this, because it's not like rents bumped up.
Hadn't gone up
in relation to these payments. Yeah. So the property having to qualify means that usually an investor right now has to get that property so far under market value for it to actually cash flow and qualify for a DSCR loan. So there's definitely opportunities out there, but they are fewer and farther between.
Those
from what
are
I've
harder
seen.
to qualify from right.
Yeah,
absolutely.
But it is a great option.
Option.
If you are, let's say you're limited on what you make, you're on a fixed income. It's a lower income, but you've got great credit. You're a strong buyer other than your monthly income, and we know that the property is going to cash flow. We know that the property is a great investment. That gives people that advantage to go ahead and close on that and get into investing in real estate.
Or you just even think about the scenario where, maybe someone's now making great income, but they've only been making that great income for 1 year. And they're confident about that income, but from a qualifying standpoint, we can't use that 1 year of great income. We've got to average it. And so there's some scenarios where it really makes more sense to go the DSCR route. Now, the interest rate's going to be higher than a standard conventional loan. But it's an option. And I think that's what's important is just do your research and find what's available.
Yeah.
Because there's some great opportunities out there in the real estate market right now.
Yeah. Well, there you have it. If you are thinking about getting into investing in real estate, like we said earlier, there are a lot of opportunities in the market right now. talk to Michelle about the money side of it. This is what she's been doing for a while now. She's been doing this for a long time, personally and as a professional loan originator. So definitely reach out to her, talk to her about your options. And whenever it comes time to finding those deals, reach out to us and we would love to help you out. Thanks for tuning in to this week's episode of the Unlocking Doors podcast, and we'll catch you on the next one.